You bought Bitcoin, you sold some for profit, you swapped ETH for another token. You earned staking rewards. Every single one of those is a taxable event, and the IRS knows about most of them because exchanges report your activity directly to the government. This isn't a maybe they'll find out situation, it's a when they catch up with you situation. This video explains exactly what triggers taxes in crypto, what the government actually tracks, and how to handle it without getting destroyed by penalties years later. Here's what most people get wrong. They think taxes only happen when you cash out to dollars. Wrong. Crypto-to-crypto trades are taxable. Selling Bitcoin to buy Ethereum is a taxable event. You're disposing of property. The IRS treats crypto as property, not currency. That means every time you trade, sell, or even spend crypto, you're potentially triggering capital gains or losses. Buying crypto with dollars? Not taxable. That's just a purchase. Holding crypto? Not taxable. That's just holding property. But the moment you dispose of it, sell it, trade it, spend it, gift it, the IRS wants to know what you gained or lost. Let's break down exactly what triggers taxes. Selling crypto for fiat. You bought Bitcoin at $30,000, sold it at $50,000. That's a $20,000 capital gain. Taxable. Trading crypto for crypto. You bought one ETH for $2,000, traded it for $3,000 worth of Solana when ETH hit $3,000. That's a $1,000 gain even though you never touched dollars. Taxable. Spending crypto on goods or services. You bought Bitcoin at $40,000, spent it when it was worth $60,000 on a laptop. That's a $20,000 gain. Taxable. Earning crypto through mining, staking, or interest. You earned $500 worth of staking rewards. That's $500 of ordinary income the day you received it. Taxable. Getting paid in crypto. Your employer or client pays you in crypto. That's ordinary income at the fair market value the day you received it. Taxable. Here's what doesn't trigger taxes. Buying crypto with fiat. You're just acquiring property. Transferring crypto between your own wallets, moving Bitcoin from Coinbase to your hardware wallet isn't a disposal. No tax event. Holding crypto, gains are only taxable when realized. You can hold forever and owe nothing until you sell. Gifting crypto under $18,000 per person per year, gifts below the annual exclusion limit aren't taxable to the recipient. But if you gift crypto you bought for $1,000 that's now worth $10,000, you're disposing of it. The recipient inherits your cost basis. When they sell, they pay taxes on the full $9,000 gain. This is critical. How long you hold determines your tax rate. Short-term capital gains, held for 1 year or less. Taxed as ordinary income. If you're in the 24% tax bracket, you pay 24% on crypto gains. Long-term capital gains, held for more than 1 year. Taxed at preferential rates, 0%, 15%, or 20% depending on your income. Most people fall into the 15% bracket. That's a massive difference. If you made $10,000 on a trade, short-term means you could pay $2,400 in taxes. Long-term means you pay $1,500. Holding one extra day can save you hundreds or thousands. The IRS isn't guessing. Exchanges report your activity. Since 2020, Coinbase, Kraken, Gemini, and every major US exchange files Form 1099-K or 1099-B for users who hit certain thresholds. They report your total transactions. Starting in 2025, the thresholds dropped. If you have more than $600 in transactions, the exchange reports it. The IRS gets a copy. They know you traded. They know approximate volumes. What they don't always know is your cost basis, what you originally paid for the crypto. That's why tracking is on you. But they absolutely know you participated. The "they'll never find out" era is over. It ended years ago. If you don't report crypto gains and the IRS catches it, and they will eventually, here's what happens. Penalties for underreporting, 20% penalty on top of the tax is owed. Interest accrues from the date the tax was due. Compounds daily. Potential audit. Once they flag crypto discrepancies, they dig deeper into everything. Criminal charges in extreme cases. Willful evasion with large amounts can result in criminal prosecution. This is rare, but it happens. The risk isn't worth it. Even if you made $500 and owe $100 in taxes, not reporting it exposes you to penalties that triple the bill. Cost basis is what you paid for the crypto. When you sell, your gain or loss is the difference between cost basis and sale price. Here's the problem. If you've been trading for years across multiple exchanges and wallets, tracking cost basis is a nightmare. You bought Bitcoin on Coinbase in 2020, transferred it to Binance, traded it for Ethereum, moved that to a DeFi wallet, swapped it for 3 other tokens. Now you're selling, and you have no idea what your original cost basis was. The IRS default assumption, if you can't prove cost basis, 0. That means your entire sale price is considered gain. If you sell $10,000 of crypto and can't prove you paid $8,000 for it, the IRS assumes you paid $0. You owe taxes on the full $10,000. You need records of every transaction: date acquired, date disposed, purchase price, sale price, which exchange or wallet. This sounds impossible, but there are tools. CoinTracker connects to exchanges and wallets, auto-imports transactions, calculates gains and losses, generates tax reports. Coinly, similar functionality, supports more international exchanges. CryptoTrader.tax, another option, often cheaper than the others. These aren't perfect. You'll need to manually review and fix errors. But they're 100 times better than trying to track everything in a spreadsheet. Cost $50 to $200 per year depending on transaction volume. Worth every penny to avoid an audit nightmare. Stocks have a wash sale rule. If you sell a stock at a loss and rebuy it within 30 days, you can't claim the loss for tax purposes. Crypto doesn't have this rule yet. You can sell Bitcoin at a loss, immediately rebuy it, and claim the loss. This is called tax loss harvesting. You're locking in losses to offset gains without actually changing your position. Example, you bought Bitcoin at $60,000. It's now $40,000. You sell, realize a $20,000 loss, immediately rebuy at $40,000. You still own the same amount of Bitcoin. But now you have a $20,000 loss to offset other gains. This is legal for crypto right now. It won't be forever. Congress is working on closing this loophole. Use it while it exists, but know it's temporary. Staking rewards, DeFi yield, liquidity pool earnings, all taxable as ordinary income the moment you receive them. If you earn 0.1% ETH from staking, and ETH is worth $3,000 at the time, that's $300 of ordinary income. You owe taxes on $300 even if you never sell the ETH. When you eventually sell that 0.1% ETH, you pay capital gains on any appreciation from $3,000. If you sell it at $3,500, that's a $500 gain, and you owe capital gains tax on $500. You're taxed twice, once as income when received, once as capital gains when sold. This is why high-yield DeFi farming can create massive tax bills even if you reinvest everything. If you donate crypto to a qualified charity, you can deduct the fair market value without paying capital gains. Example, you bought Bitcoin at $20,000. It's now worth $50,000. If you sell and donate the $50,000 cash, you owe capital gains tax on the $30,000 gain. If you donate the Bitcoin directly, you deduct the full $50,000 and avoid the capital gains tax entirely. This only works with registered 501(c)(3) charities. Gifting to friends or family is different. Gifts under $18,000 per person per year aren't taxable to the recipient, but if you gift appreciated crypto, the recipient inherits your cost basis. When they sell, they pay the taxes. This video focuses on US federal taxes, but state taxes vary. California, New York, New Jersey tax crypto gains as ordinary income at state rates on top of federal. Texas, Florida, Wyoming. No state income tax. Your crypto gains are only federally taxed. Portugal, Germany, Singapore. No capital gains tax on crypto held beyond certain periods. If you're not in the US, research your country's specific rules. Some countries are crypto-friendly. Others treat it as currency and tax every transaction as a forex trade. Know your jurisdiction. If you haven't reported crypto taxes for past years, fix it now. The IRS offers amnesty programs for people who come forward voluntarily. You'll owe back taxes and interest, but you avoid criminal penalties. Don't wait for them to find you. File amended returns for the years you missed. Use a crypto tax tool to reconstruct your transaction history. If you genuinely don't have records, do your best to estimate based on exchange exports and wallet histories. The IRS prefers incomplete, accurate reporting over no reporting at all. Consult a tax professional who specializes in crypto. This isn't DIY territory if you're years behind. At minimum, a crypto tax software, CoinTracker, Coinly, or CryptoTrader.tax, $50 to $200 a year. Records of every transaction, exported from every exchange and wallet you've used. CSV files work. A CPA who understands crypto, if your situation is complex, DeFi, NFTs, mining, international exchanges, hire someone who specializes. General accountants often get crypto taxes wrong. Crypto taxes are a mess. The rules are complex. The IRS guidance is incomplete. Tracking is manual and painful, but ignoring it doesn't make it go away. Every year the government tightens enforcement. More exchanges report, more data gets shared internationally. The window for maybe they won't notice closed years ago. You don't have to love the tax system, but you do have to deal with it. The people who get wrecked are the ones who assume they're invisible until the IRS sends a letter demanding 5 years of back taxes plus penalties. Start tracking today. Even if you're behind on past years, begin accurate record keeping now. Every trade, every sale, every staking reward, use one of the tax tools. Connect your exchanges. Export your data annually. When tax season comes, you'll have everything ready instead of scrambling through years of transaction history. This is boring. It's not why you got into crypto. But it's the difference between keeping your gains and losing half of them to penalties. Comment tracking if you're already using a crypto tax tool, or behind if this video just made you realize you need to catch up. Next video, I'm explaining tokenomics, how to spot red flags in a project's token distribution, and why some coins are designed to dump on you from day one. Subscribe to Unbanked. The old money had a head start. You have the internet.